Hi traders! In this video, we are going to learn what are stocks and what are some basics that we need to know about trading. When you buy a stock, you're buying a piece of a company. I'm sure all you guys have heard of a company going public. That means a company is allowing anyone who is interested in investing to own a portion of it by purchasing its stock. This action happens in the stock market. The stock market links up buyers and sellers to trade financial instruments such as stocks. When you buy a stock, you're buying from someone, whether that person is a company or an individual. And the same goes for when you sell a stock, you're selling it to an entity. So let's take Tesla for example. Currently, Tesla is trading at $700. If you are looking to sell Tesla for $750 right away, chances are your order is not going to get executed because people who are looking to buy are most likely only willing to pay for a Tesla share at its current value. If you're looking to buy Tesla at $650, it's also not likely to go through, since the current sellers will be less likely to sell at $650, which is a loss of $50. You should also remember that market consists of a large amount of traders who are actively placing orders. And just because a company is valued at a certain price, that doesn't mean that you can sell or buy at that price. If the sell orders are all set at above that mark, then you won't be able to make a purchase at the current mark. Although this is very rare, situations like this can happen and happens more often in options trading, which we will be talking about in later videos. So like I mentioned earlier, stocks, shares, and equity all means a stake of ownership in a company. If a company has total 25 shares and each share is trading at $4, that means the company is currently worth $100. The stock price multiplied by the total shares is also known as the market cap of a company. Since we are on the topic of market cap, it is important to know that just because a stock is trading at a higher price, it doesn't mean that the company is worth more. And vice versa. If a stock is trading at a lower price, it doesn't mean that the company is worth less. For example, Tesla is trading at $700 right now, and Apple is trading at $120. Does that mean Tesla is more than 5 times bigger than Apple? Absolutely not. If we check the market cap, Apple is currently at $2 trillion and Tesla is only at $640 billion. So you might ask, why is Apple so much cheaper? Well, if we check the total shares, we can see the reason. Apple has 16.82 billion shares, and Tesla only has 947 million shares. That is a huge difference. So now that we have a better understanding of what is a stock and its relationship with a company, we are ready to dive into some trading basics. We all know that trading happens in the stock market, and just like any other types of market, it is not 24/7, except for cryptocurrencies, but that is a whole topic for another lesson. So be sure to subscribe so you don't miss any of our content in the future. So buying stocks are just like getting groceries. You need the stores to be opened in order to buy your groceries. Even if you can order them online at 2 a.m. in the morning, you still have to wait until the workers to come in the morning to process and ship your orders. For stocks and other financial instruments, you can also place an order anytime you want, and your broker will process your orders during market hour. There are 3 periods of time when our brokers will process our orders, and those are pre, post, and normal market hours. Pre-market is between 4 a.m. and 9:30 a.m. Eastern. Normal trading hours are between 9:30 a.m. to 4 p.m., and after hours are between 4 p.m. and 8 p.m. Pre and post market are usually when companies release their earnings report, and normal trading hours are when the most transactions occur, and usually when our guy JP comes out and tells us everything is going to be alright. Here are some important things we need to know about pre and post market trading. Your orders are harder to execute due to a lot less active traders during after hours, and you can only place limit orders. So if no one is setting a matching but opposite limit order, then your order won't go through. This is an important thing to know, as some stocks do make big moves pre or post market, but that doesn't necessarily mean that your orders would be executed. So what is trading? I think everyone knows this one. It's buying something at a price and selling it at a higher price to the next person. Sounds very simple, right? Well, it is, on paper at least. So what makes trading challenging? It's your mind. It's the psychology aspect. You can own shares of the best company in the world, and you will not turn a profit because anything could happen to any stocks at any given time. So if you don't have a good mental discipline, it's going to be tough to make money consistently in the stock market. To be honest, a lot of people, including myself, are affected by our psyche. So how do we trade? And how do we control our mind? There are two ways that we can do to ensure we have a better chance to win and not get too affected mentally. Those are making sure that the trade will have a good chance in going in your favor and risk management. Before we go into more details, we need to know that no one knows what the stock market will do in the future. So if that's the case, how do we increase our chance for the stock to go in our favor? We can say that a stock will go up because of these reasons, and we should think about these reasons over and over to make sure they are unbiased. This way, we can at least know that the stock has a better chance to go up rather than to go down. Here's an example. Let's say stock A has been going up and down between $3 and $6, and so the next time when it hits $3, you're expecting the stock to go up to $6 again. And based on a historical price, it has a good chance of going back to 6. This is just one of the examples that could be a reason to buy. But like I mentioned earlier, there's no guarantee that stock A will go back to $6. It could go down to $2. This is a risk involved in trading that cannot be completely avoided. So here's where you can say, okay, I did not expect this to go below 3, and I admit that I am wrong by taking a $1 loss. This is risk management. Based on the chart, your anticipated gain is $3, and the max loss you are willing to take is $1. Your risk and reward ratio is 3 to 1. Let's assume that every trade you win, your gains are $3. Obviously, this won't always be the case. But assuming it is, let's say you make 100 trades, and you're right 30% of the time. So your gains are $90, and your losses are $70. That makes your net gain $20. Now, you can see the importance of managing your risk, since obviously you won't be making only 100 trades. Another way of managing your risk is by controlling the size of your entry. If I buy 50 shares of stock B at $2, the maximum amount of money I can lose is if the stock goes to 0, and that is $100. But if I buy 20 shares of stock C at $50, then the maximum amount of money I can lose is $1,000. So clearly, I could lose more money trading stock C than trading stock B. I want to emphasize though, this is not to discourage you from trading higher priced stocks, but rather to be very clear on having an exit strategy. In later videos, we will learn a type of orders that can help you limit how much you can lose in a trade. But the general idea of bigger position, bigger risk is still valid regardless.